Everyone. This is Paul Kuntz with Redship Companies. I want to thank everyone for joining today's event with Phoenix Motor. Phoenix Motor trades on the OTC under the ticker symbol PEVM. With us today, we have Phoenix Motor CEO Denton Peng, COO Louis Liu, and CFO Michael Young. We will begin with a brief presentation in a moment, and then we will open up the call for questions after that. Any of the attendees, you may submit a question at any time by simply clicking the Q&A button at the bottom of the screen, and we will get to those once we get to the Q&A session. Before we begin, I do need to read the safe harbor statement real quick. This call, of course, may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking, and of course, forward-looking statements involve risks and uncertainties. With that said, I will now turn the call over to Denton. Please go ahead.
Thank you, Paul, and thank you to everyone joining us today. We appreciate your continued interest and support as we discussed our latest developments. Phoenix Motor remains focused on a clear mission, leading the transportation to zero-emission or electric transportation solutions. We are proudly positioned as a leader in the electrifying commercial transportations, serving an extensive area of EV markets. Our commitment have translated into more than 6 million mile cumulative zero-emission mile driven, delivering substantial cost saving and notable environmental benefits. Since our last update, we have continued to drive significant strategic progress. Most notably, we have expanded our global manufacturing capabilities through a strategic agreement, establishing our new manufacturing presence in Mengzhou, China. This agreement will strengthen our supply chain and significantly enhance our production efficiencies, enabling us to meet increasing global demand while remaining committed to final assembling and customization at our Anaheim facility in California. Thus, continue our strong support for local job creation and compliance with U.S. manufacturing standards. Additionally, earlier today, we announced the launch of the PhoenixEV MEV2, our California-based assembled low-speed electric delivery vans. This innovative mini vans EV is purpose-built for the rapidly growing gig economy and last-mile delivery market. With these vehicles, we are also introducing our products from commercial market from middle duty, heavy duty to light duty. Finally, we maintain a robust trajectory with a sharpened focus on profitability and operational efficiencies. Despite expected quarterly fluctuation due to strategic conditions and normalized delivery patterns, we continue to deliver improved gross margins and cost management reductions. As we're looking ahead, while ambitious growth plans remain on track, supported by strong customers' demand, expanding product portfolios, expanding to international markets, and a favorable regulatory environment. Importantly, we remain confident to achieve more revenue and profitabilities in coming quarters and years. With that, I'm pass the call to our Chief Operating Officer, Louis Liu, who will provide more detailed insight into our operations, including our recent strategic initiatives. Dr. Louis.
Thank you, Denton. I am pleased to provide an update on our recent operational development and strategic initiatives, highlighting Phoenix Motors' ongoing leadership and innovation in the electrified transportation sector. Firstly, our recent announced strategic manufacturing agreement establishing operations in Mengzhou, China, marks a significant milestone for Phoenix Motors. This landmark deal expands our manufacturing capabilities with an additional over 1 million square feet of state-of-the-art vehicle production facility, substantially increasing our total global manufacturing footprints to over 1.3 million square feet. Remarkably, this facility comes to rent-free, for the next 10 years, greatly enhancing our financial flexibility and operational efficiencies. At this facility, we will not only produce critical high value components such as battery modules, body stampings, and e-axles for vehicle assembled in the US, as Denton mentioned, but also manufacture complete vehicle specifically targeted for markets like South America, Caribbean regions, and other international regions. Importantly, the final assembly rigorously quality assured and pre-delivery customization for US market will continue at our Anaheim facility and continue our strong traditions of local job creations. Secondly, we are particularly enthusiastic about our recent introduction of the Phoenix MEV2 LSV, a California assembled low speed electric vehicle purposely built for the booming gig economy and last mile delivery sector. This new vehicle is strategically tailored to the unique needs of dense urban environments, offering an impressive 120 miles of real world range per charge, designed to accommodate the specific requirements of operators like Uber Eats, DoorDash, and Intercat, as well as broader logistics providers. The MEV2 will feature fast charging capabilities and extensive customization options, including multiple color choice and rack ready panels for enhanced branding and advertising opportunities. The MEV2 also serves as the cornerstone of our newly offered products to our potential business partners, providing fleet as a service platform. This comprehensive solution integrates vehicle leasing, charging infrastructure, maintenance, and advanced telematics into one streamlined subscription offering. By dramatically simplifying fleet electrification, or offer to FAAS partners significantly reduces their operational complexity and total cost of ownership for fleet operators, positioning Phoenix Motor as a true partner in our customers' transition to sustainable transportations. Beyond this strategic initiative, Phoenix Motors establishes operation delivers the scale, reliability, and competitive modes investors demand in the category leaders. Our two U.S. plants in Anaheim, California, Greenville, South Carolina, already provides a coast-to-coast footprint in the massive U.S. market. As I noted momentarily ago, layering the rent-free over 1 million square foot Mengzhou facility lifts total capacity to more than 1.3 million square feet, securing supply, lowering unit costs, and giving us headrooms to satisfy certain domestic and international demands. We have over 1,300 zero emission vehicles on the road in 43 states, gathering real world data that continuously fit product improvements and creates a growing annuity of service and parts revenue. Crucially, 70% of those orders are coming from repeat customers, a testament of vehicle reliability, brand loyalties, and structurally lower customer acquisition costs. From route analytics and charging design to financing, telematics, and on-site training, Phoenix embeds itself in every stage of a customer's electrification journey. These high-value services reduce switching costs and deepen wallet share over the fleet life cycle. On the heavy-duty vehicle side of our business, or Buy America compliant transit buses already qualifies for more than 1 billion in annual zero emission transit funding that federal government actually provides. And Our medium duty lineup offers compliant options as well. With mandate accelerating, Phoenix offers agencies and fleet operators a turnkey path to meet or even exceed their sustainability targets. Taken together, our expanded manufacturing footprints, sticky customer relationships, and vertically integrated services platform position the Phoenix Motor for sustained top-line growth, margin expansions, and long-term value creations. We are not just participating in the electrification revolution, we are actually engineering it. With that, I will pass the call to CFO Michael Young to review our financial results for the first quarter. Michael.
Thank you, Louis. Q1 results showcase the earning power of our streamlined business model. Even as we lap an extraordinary comparison period, revenue came in at $4.4 million versus $9.4 million in Q1 last year. But it is important to remember that the prior year quarter included a significant non-recurring revenue boost from sales of pre-owned buses that we inherited with the Proterra acquisition, essentially monetizing legacy inventory rather than repeatable revenue stream. Adjusting for this discrete item, revenue came from our ongoing vehicle and service program grew year over year, underscoring the healthy demand and strong execution. Margin tells a deeper story. Gross margin expanded. The gross margin expanded to 30.9%, up more than 430 basis points from 26.6% in a year ago quarter, and well above the 23.6% we delivered in full year 2024. A step change reflects richer product mix, disciplined pricing, and early return on our integration and cost reduction initiative. Operating expenses were $3.3 million, a sharp reduction from $8.6 million last year as we capture synergy, rationalize overhead, and adopt leaner and more agile structure. The resulting operating profit positioned us to scale profitably as new programs like the NEV2 and our expanded manufacturing partnership with China come online. We reported a net loss of $2.8 million this quarter versus a $16.8 million profit in Q1 2024 that included a one-time $32.9 million gain tied to the Proterra acquisition. On a normalized basis, the string illustrates our progress towards breaking even as we invest in growth while maintaining cost rigor. Turning to the balance sheet, the cash increased to $0.83 million, up modestly from year end. A total equity remains strong at $9.4 million. During the quarter, we also secured a $6 million loan facility and initiated a $5 million share repurchase program, reinforcing our commitment and disciplined capital allocation to shareholder value. Looking ahead, first, expanding order book in both domestic and international market. Two, a ramp of our rent-free Meizu manufacture facility. Three, initial deliveries of MET2 partner with our new FAAS agreement model. Coupled with continued margin expansion and cost control, we believe those catalysts position Phoenix Motor for marginal earning acceleration over the balance of the year. Before we open the floor for questions, I just want to leave our investor with three clear takeaways that underscore why Phoenix Motor is positioned to create a meaningful long-term value. First, capital efficiency manufacturing, built for global demand with more than 1 million square feet of production capacity spanning from California, South Carolina, and our rent-free facility in Meizhou. Now we are command an asset base that rival far larger peer without the burden of heavy fixed costs. This footprint secure our supply chain, lower unit economics, and enable us to pursue high growth market in North and South America and beyond. Second, a diverse high margin growth engine. As I noted, Q1 gross margin expanded to 30.9%, and we have clear line in sight for further improvement as high value product like the ME2 enter into production. Our partnership with FAAS model begin generating recurring subscription revenue and value ran through existing plant and our new Meizhou operation. Those levels, combined with disciplined cost control, position us to convert top line momentum into accelerating earning. The third key takeaway, we have great structure, demand, and proven customer base, regulatory mandate, and more than $1 billion in annual zero emission transit funding continue to expand our addressable market. With 1,300 plus vehicle already on the road and a 70% repeat order rate, every deployment deepen relationship, generate data, and continuous improve and fuel an annuity stream of parts and service revenue. An additional robust balance sheet, a near-term catalyst, ME2 pilot delivery in this Q4, international vehicle shipment in 2026, and ongoing software and autonomous initiative. And we believe Phoenix offer a compelling opportunity for investor. Simply put, we're not chasing electrification wave, we're engineering it, commercializing it, and capture the economic upside today. Thank you all for your continued confidence in Phoenix Motors. And we look forward to updating you on our progress. And now I'm happy to take your question.
Thank you, Michael. And I want to remind our attendees, if you do have a question, you can click the Q&A button at the bottom of the screen and just type in your question, and we'll get to those as they come in. We've had several that have already come in. One of our first questions was regarding today's news. It was how quickly can you ramp production in China, and how will this operation impact your margin profile and competitive position over the next couple of years?
Yeah, let me take up this question. I think if you look at the MEV2, there's the mature products out of that factory. So as far as the ramping up, the production is fairly short. What I mean by short is what we need to do is more like prepare the capitals for the material to run whatever the batches we're actually anticipating, especially from the market needs. And then we're able to, to make major components into the CKD and come over to our Anaheim facility to final assemble it and then push it out. So fairly quick to get it produced. Actually, I hope I answer your question, because this is not brand new products. It's already running through the lines. We have the stamping, the molds, everything ready. It just once we commission it, get the orders from the market. Actually, we have a very strong response on the the low-speed vehicles, and it is fairly not very jammed as far as the players in these particular segments. So we can quickly put the products into the market.
Excellent. Thank you, Louis. And we have another question. Based on current performance and operational plans, when does the company anticipate reaching a positive net income again? And what are the key drivers and milestones that will lead to sustained profitability?
Okay, I would take that question. As we continue to build and scale up our profitable segment of the business, we expect to be profitable in the near futures. We are facing a lot of challenges out there. The challenge that we face that has put a major headwind in our ability to make money today, as an example, as we continue to see supply chain causing a lot of issues. Supply chain now take even longer than before, and with all this new tariff in place, so the profitability is going to take slightly longer as we continue to sit down and try to evaluate what the additional costs will be. The positive is we are able to somehow pass along some of the costs to our customers, but not all of them. So like before, 6 months to a year ago, I expect that we need to make between 60 to 75 buses to break even. Today, with the current cost reduction, so on and so forth, I expect that we should be able to break even between 40 to 50 buses. We should be able to break even. So depending on the capital, depending on all the tariff and all the supply chain issue, so it'll be slightly difficult for me to give you an exact answer, because all things, things change on a second basis. One day we are 10% tariff, and next day I'm on 30%, and next day I'm 150. So it makes it a little bit more difficult for us to be able to answer that question as of this moment.
Thank you, Michael. And our next question, could you provide more detail on your strategy for South America and other international markets? So what makes these markets attractive for Phoenix, and what early indicators of demand are you seeing there?
Let me speak for the market and business development. For what I know, we definitely organized and participated in a few events which actually strictly focus on the Caribbean countries in South America, right? So the reason we pick up that market is one, it's close to us, and the second, before we actually jump into the international market, we have already received inquiries about our ZX5s and other, smaller vehicles for the commercial purposes. So that's why we actually start looking to how we can supply the products, how we can offer the services, right? So that's basically the demand-based requests. And we actually continuously run some of the marketing events and business development events with the Caribbean countries. And the response on the buses, especially the 12-meter buses and 8-meter buses, and also the smaller Uber-based vehicles for the delivery on both, goods and people, are coming very, very strong. So that's why that especially push the operation that's on my side to look into how we can quickly, develop the products and quickly commercialize them in that market. That definitely has to have some kind of involvement on the homologation on the vehicle to meet the local regulatory requirements, basically. And the vehicle we actually currently plan to assemble in California, they have certain level of the certification already. So that means we are able to quickly to put those vehicles in those markets. And once we put them in, especially the first batch, and then we are expecting more demands to flow in, so we can continue to roll that ball in the South America.
Great, thank you, Louis. And another question we had, the recent reduction in operating expenses is encouraging. How sustainable are these cost savings, and can we expect to see similar levels of reduced expenses in the upcoming quarters? And what measures are in place to maintain or further improve operational efficiency?
And let me talk first, and then I'm going to let Michael to continue to add. Operational wise, all the cost saving efforts which we have done so far, those are pretty much structural. And what I mean by that is that's definitely sustainable, right? I give you some examples. One is the integration and leverage, in the U.S., the West and East, facilities, and also the team, and also the systems, right? So supply chain as well. So those leverage and the integration definitely has a permanent impact on a continual basis. We actually currently running the lean operation program, so that will continue to drive the waste out and basically achieve the cost savings continuously. That's continuous improvements. The third, once the China coming in, definitely we're able to extend the supply base globally, especially to the low cost country, and then that will benefit the cost saving even more. And definitely our scale on the production side goes up, and the procurement cost is going to continue to drive down, right? So that's all on the healthy cycle of the cost improvements, and that's pretty much sustainable. And the continuous improvements is going to give us that kind of edge to continue to improve the costs. Michael, anything to add?
No, actually, basically, what Louis has said is well, basically, right now, based on what we have, we do the best we can. On the biggest thing is trying to reduce costs on whatever we get in terms of parts, and also we are extremely careful in terms of our labor costs. So if we're only producing 50 vehicles this year, we're only going to have the right amount of employee to produce it. So this is way that this allow us to continue to focus on our costs.
Yeah, basically the idea on that is to make the operation more flexible, meaning depends upon the market demands, the changes of market demands, right? So if the market goes up, we actually have a bigger team to support that. If market go down, and then we actually reduce the entire workforce. So that's on that side. So the flexibility and lean is the key to keep the cost level accordingly.
Thank you, gentlemen. And we've had quite a few folks asking about the status of Phoenix relisting on NASDAQ. Can you all provide a comment on that?
Yes, we are continuing to applying for relisting at the NASDAQ, but with NASDAQ, it could take up to between 4 to 6 months to be relisted back to NASDAQ, but we're continuing working with our legal firm to apply for relisting of the NASDAQ. So a lot of time is, just like, we try to get this thing done as quickly as possible, but NASDAQ, they take their time, and whenever they want to have a meeting with us and so on and so forth. So right now we are reapplying to be listed back on NASDAQ. So that timing, I'm looking at between 4 to 6 months.
Thank you, Michael. And we also had several different questions regarding the guidance previously issued. You've previously guided for $40 to $50 million revenue in 2025. Is the company still confident that it can achieve that?
As a manufacturer in US, we originally gave out a guidance. We are trying our best to meet those guidance, but things change. Right now, we are facing some major headwind with regard to some of our supplies, and because the cost is going up quite dramatically, so we are going to be adjusting our expectation as every quarter goes on. We will be making those adjustments.
Thank you, Michael. And we have another question about yesterday's news. Could you talk more about the rent-free facility in China? What's the catch?
Yeah, I think let me take up that. I actually personally be there Actually, I'm still here, in China. So it's early morning here. So I personally actually sitting in discussion, negotiating the deal, and it works like this. I mean, the entire factory, it's been invested. All the equipment's already, uh, um, the capital investment already done. So the deal between us and them is the entire facility actually is for us to use. We just signed the lease agreement for roughly like $1 or something like that. It's almost no cost to us to fully utilize the entire facility. The facility has over 7 million square feet land and huge factory, and so it's pretty much like rent free, right? So even there's $1, but still rent free. We consider that as rent free, and the agreement is it's more like we can use that factory for 10 years. Okay, and after 10 years, once we meet some certain criteria, and then everything is back to us. Okay, so um, the criteria could be like the taxes which we generated from the continuous operating from that facility, and also employment and stuff like that. And after 10 years is going to be us. Okay, so that's basically very, very high level summary on what that means.
Very good, thank you. And we did have another question. Could you share more details on the progress and plans regarding the $5 million share buyback program?
Yes, the reason we announced the $5 million share buyback, I think towards the end of last year, the board approved a 5 million share buyback because we have 9 buses sitting in our inventory that we're trying to sell. As soon as we could get those buses sold, we expect to use some of the proceeds to start purchasing some of our share back. The main reason for the share purchase buyback is because that we think we are tremendously undervalued today, because if you compare us to other EV companies, we are losing a lot less money than anybody that's out there, but they're trading at multiple that's way above us, and we think we're tremendously undervalued. And the management team and the board think that we should buy the stock back at the current price, to help out our valuation and going forward.
Thank you. And actually, to the prior question we had, we have a follow-up. Could you answer what the other party is getting in return for the rent-free facility?
Not what I'm aware of.
Well, you know what, Louis, let me add to that a little bit, okay? Everybody know the Chinese has built a lot of EV company out there, and a lot of the EV company has went under. What we do there is that we're creating jobs and we're creating revenue and taxes for them. So it's not exactly rent free to them, but it's rent free to us. But in return, they are getting employment in the local city, and they're getting tax revenue for the local city. So it's a win-win for us and for the local municipality.
Excellent. Thank you for that clarification, Michael. And then we have another question. In the presentation, you touched briefly on autonomous and software initiatives. Could you share a little bit more on what the strategic vision is for integrating autonomous driving technology into your vehicles?
I hope our CTO is here.
Okay, let me take the
Oh,
question.
Tony is there. Okay.
Yes, let me take the question. So we have the long-term strategic plan for the autonomous driving technology development. We partnership with EdisonFuture. EdisonFuture has the production in European country and the Middle East. They also have something like a trial version that autonomous driving technology, L4, actually in Japan. So they also have 2 years right now, so that the autonomous program is running in the Michigan State at Lansing. We are adopt all the newest technology from EdisonFuture, integrate with the platform. We have a 40-foot bus platform. We also have the platform. We're going to implement that. Not only we talk about the that's the commercial bus, autonomous bus. We also try to carry on the autonomous driving technology to that another segment, for example, that's the autonomous shipping truck. This is what we plan to do. So we are still planning on that too. We also working with the supplier, try to stabilize our position in autonomous driving technology. For the autonomous, everybody know this safety is a top concern. So after my involvement, I would like to introduce another active safety integrity levels, which is in our product, which is totally change currently the technology to next level, which is involved all the AI technology with the currently existing newest technology. So I'm very confident that our autonomous program is going to success. So we present the robo transit bus to the market very soon. Our first demo vehicle will be ready after 6 months. So everybody should be remember that what I said. 6 months we're going to present to the market, have a demo model autonomous bus.
Very good. Thank you, Tony. Tony, very exciting. I guess with that, is there any closing comments that the Phoenix team would like to leave with the audience?
Louis, would you like to add something?
Yeah, first of all, continuously thank you for everybody to supporting us. And what we intend to do here is definitely from operational side of it, we continue to drive the cost down, leverage the scale, and right now we have extension to the international footprints, right? And we continue to leverage that part of it while we continue improve here at home in US on the cost base. That's one. The second thing is we intend to be a leader, technology leader, and definitely the technology side as autonomous bus and also AI type of things, and also the microcommuter type of business model, new business model, and the apps, on hand to attract the ridership and maintain the ridership for the transit agencies, and also some other areas technology based where we're all interested in utilizing those advanced technologies for the benefits of our customers and partners. And we also leverage the partners' technologies and product and services as well. So one example on the service side, I'm surprised today there's nobody asking the questions on the service side. We actually gradually rolling out the open service strategy. So we partner with some other service providers, and also we have some new business model created to actually improve the service on our end for the customers in the marketplace. So thank you very much for everybody here to have a faith on us. So that's basically the source of energies for us to move on to continue to create value for the marketplace,
Yes.
for the investors as well. Yes.
Yes. I'm gonna end this for our investors. Just like what we said, we're not chasing electrification waves, we're re-engineering it. We're partnering out with multiple partners out there, going from servers to autonomous driving to the latest battery technology. We're forming partnership across the globe, and we're focusing on cost. And with all of that, we are going to re-engineer how electric vehicle works and make sure that we're enhance all our shareholders' value. So thank you, everybody.
Thank you, gentlemen. And for our audience, for more information on Phoenix Motor, you can give us a call here at RedChip. It's 1-800-RED-CHIP. That's 1-800-733-2447. Or you, of course, can email us at PEVM@redchip.com. That's just simply the ticker PEVM@redchip.com. We also have a page for Phoenix on the RedChip website at redchip.com/stocks/PEVM. And there you can download the latest investor presentation, fact sheet, and of course also sign up for news alerts on Phoenix so you can stay abreast of the latest developments. Also, if you want to register for any future Redshift webinars, you can go to redshift.com/events, and you'll also be able to find an archived version of today's webinar there within the next hour or two. So I want to thank everyone again for attending, and I want to thank you all at Phoenix for the presentation, Denton, Lewis, Michael, for sharing the Phoenix Motor story today. We look forward to having you back to share more of those successes.
Thank you.